and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
It's not a surprise that the consumer's feeling well. It's actually been a little bit more of a surprise that the consumer had felt a bit challenged. We have a historically low unemployment rate, and the wealth effects of investing in the market continue to go up. So it shouldn't be a major surprise that consumers are feeling well.
One thing to keep in mind is you don't know if sell in May works until June, right? I mean, sell in April didn't work. We know that. Sell in early May didn't work. We kind of know that. But we don't yet know if sell in May didn't work. We're coming into this month, we're ending this month, I should say, on a very exuberant note. Stock, basically no matter how you measure it, there's very little fear and a lot of greed.
One of the key elements of the buy now pay later products that we offer is zero interest. And so to some degree, we're seeing, a continuous acceleration of our growth and preference among US consumers due to the fact that actually from that stretch, a lot of that stretch comes from the higher interest rates on the credit cards and other lending products, right? And actually to some degree, buy now pay later becomes a more attractive offer.
We've got 1 hour to go until the market close, so let's take a look at the major averages. While that exuberance over the longer term does remain intact that you heard Steve Sosnick talking about just there, we've got a little bit more of a mixed picture today, and that's because the big economic data of the week comes at the end of the week. That is in the form of PCE, which is the Fed's preferred inflation indicator. That said, we did get a reading on consumer confidence today that showed a rebound for the first time in 4 months. That coming to us from the Conference Board. That not really mitigating the declines we're seeing at the moment, with the Dow down about 300 points, off about 0.75%. The S&P down about 0.25%. The Nasdaq is the outlier here today to the upside. It's at the lows of the session, but still up about 0.25%. And as we try and weigh all of this economic data, we see the 10-year note, the yield back above 4.5%. We haven't seen it at that level in quite some time. A pretty big move upward today of about 7 basis points. So that may be causing a little bit of concern. We're up at about the same level that we were really coming into May, so something to keep an eye on there. Also watching what's going on with the sectors today. We've got healthcare, industrials, financials that are weak. Energy and tech are on the rise today. And speaking of tech, when we talk about the Nasdaq being the outlier to the upside, we're going to dig into it later. But Nvidia rising to another record today. Amazon and Alphabet also on the rise, but really that strongest performer there would be Nvidia among large cap tech, Josh.
All right, Julie. Stocks mixed as investors' attention remains focused on the Federal Reserve and their path to get inflation back to that 2% target. For more on what's ahead for the market, let's welcome in Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, it is good to see you. So as you heard Julie there, stocks wavering today, Rob. But of course, we had a nice rally. So where do you think, Rob, the market heads kind of near to intermediate term here? Do you want to be putting more money to work at these levels, Rob?
Well, certainly today, this week, it seems a little tough. We've got a lot of questions ahead of that Fed measure of inflation, the Fed's preferred measure of inflation on Friday. But over the longer term, yeah, we think this is a growth-oriented market where the economy is holding up fairly well and there's room for earnings to continue to expand. We've seen analysts start to take up full year 2024 earnings expectations. We're estimating around $244 a share, depending upon which service you look at. And that's probably enough to keep this market in positive territory for the year. Still lots of questions ahead, but we'd be constructive over the long term, maybe a little cautious watching this week as the data unfolds.
Hey, Rob, it's Julie here. So what could be, of all of those questions, which is perhaps the most dangerous for the market, so to speak?
Wow, yeah, well, certainly we have the election coming up. That's probably a question, but probably a couple of months down the road. In the near term, I think the question is, what is the Fed doing? And that's some of what I think we're seeing with the tape today is there's a lot of questions from the market about Fed speakers and how likely is the Fed to start to cut rates. We're now seeing that maybe it's not an event until November or December, and maybe we get one this year instead of multiple. So I think that those Fed speakers remain highly important, and how that inflation data evolves is where the market is going to be really focused.
One issue, Rob, I want to get your take on this, because Ed Yardeni, the strategist and economist, in his note to his clients this morning, Rob, he really zoned in on geopolitical conflict and what's front and center there, really. And of course, Russia, Ukraine, Rob, and China, Taiwan, Israel, Hamas. How do you think about that as a strategist in terms of just kind of economic and policy implications?
No, great point. It's something where we really haven't seen much of a market impact yet, but where for our clients, we're thinking about it as really being the epicenter in commodity markets. Commodity markets in general are in shorter supply right now, whether we think about oil, metals. We're even seeing some supply disappointments when it comes to the U.S. grain inventories. So we've actually thought that we want to own some inflation protection in portfolios against those geopolitical risks. And we're thinking about broadly diversified commodity exposure there.
At the same time, it's interesting because, obviously those are also a risk, as you said, to the upside for inflation. When you were talking about what's going to happen with the Federal Reserve this year, at this point, does it matter to equity markets if there's a cut or not? In other words, is it almost agnostic to there being a cut?
I think it depends on which sectors. So the agnostic part is probably the artificial intelligence and growth part of the market, that we're seeing just natural growth rates with or without the Fed cutting rates. But we've seen smaller companies, interest rate sensitive companies, thinking utilities and real estate, have struggled with higher rates for longer. That could be the challenging part of the market. Is if they don't get Fed rate cuts, is there some further pressure on those multiples as we look over the rest of the year?
And Rob, just sticking with the Fed, Jay Powell's favorite key inflation metric, PCE, Rob, we're going to get that on Friday. What do you expect? How important do you think that is to the market?
I think it is fairly important. I mean, the surprises would be outside if we overshoot last month's reading or undershoot last month's reading. Right now, I think consensus is about a 0.3% increase, about 2.8% year over year. We don't have anything to tell us to think differently than that, but we'd be worried if there was a significant overshoot or undershoot, and that's where the market would really start to react.
Are there any other places in the market that you think it's good to be? I mean, would you be in artificial intelligence, for example, as well as you mentioned some of those commodities, but AI on the other hand, is that a good place to be?
Well, some of those names have certainly seen a surge in the last week and the last couple of days. So it's tough to buy at these levels. But in the longer term, yes, we think that's a place that investors need to have some money put invested, just to be able to benefit from what looks to be longer term productivity growth, but is right now at least an epicenter of corporate investment.
How about fixed income investors, Rob? Listen right now, if they're looking for advice, what's your guidance?
Yep, we're really interested in looking at credit, both in the municipal space and in the corporate space. We think there's room to run here, even though you're seeing valuations are on the rich side. That this solid economic growth scenario we have for the U.S. economy is giving companies earnings room to run and earnings and some room to kind of continue to make those payments. So we think there's room for investors to kind of capture that extra yield, whether it's high yield corporate bonds, AAA collateralized loan obligations, and in the municipal bond space, we'd look to the lower quality end of the market because we think there's still kind of low distress there and room for people to capture those yields.
All right, Rob, good to see you. Thanks a lot.
Thank you very much.
We're just getting started here on market domination. Coming up, shares of Nvidia are soaring to another all-time high today on the back of an announcement from Elon Musk. We'll check in on the latest trending tickers on the other side. Plus, a slew of retailers are set to report quarterly results this week, providing insight on consumer spending. We'll take a look at the sector in today's Investor Playbook.
And at 4:30 Eastern Time, it's the latest edition of Asking for a Trend. I've got you covered with the biggest market-moving stories affecting your money. Stay tuned, more market coverage after this.
Let's check in on some of the top trending tickers from yahoofinance.com. Nvidia, top of the leaderboard today. Yet again, those shares are trending higher following an announcement from Elon Musk that his AI startup XAI is in the process of building a supercomputer to be powered by Nvidia's chip technology. Really, what we learned is how much he had raised in order to power that $6 billion, valuing all of XAI at about $18 billion. And there has been talk in the past that he was going to use Nvidia chips. So this confirmation that he raised the money, it was like, okay, now he has the money to pay for all those chips.
Yeah, that's right. I mean, it's interesting because what Elon Musk is kind of saying here is that when it comes to these LLMs, these large language models, I'm going to be a player with XAI. And you kind of already know, Julie, who some of the core winners are going to be there, like, OpenAI and Meta. But he's now saying, listen, XAI is going to be one. I was impressed with some of the investors who piled in here. I mean, these are marquee names in Silicon Valley that put money to work. It's Andreessen Horowitz, it's Koya, and when he raised $6 billion, to your point, listen, if you're going to be a player in LLMs, everybody knows you're going to need Nvidia. So a lot of people banking. Right. You just raised $6 billion. How much of that is flowing right to Jensen?
Yeah, I mean, and he has said in the past that he would need that 100,000 specialized semiconductors for this for Grok, which is XAI's
his chatbot.
Chatbot, exactly. Grok from Stranger in a Strange Land. Did you read that book, Josh?
No, I didn't.
It is
learn something new every day.
It is a sci-fi classic, and to grok something is like to implicitly understand something from your fellow humans.
It all comes together. I never knew that.
That's what that's what Grok is from.
Go ahead.
I was just going to say, I mean, it's interesting now because you do have the kind of different AI companies sort of clearly laid out along with who's backing them. So you have XAI, as you mentioned, with Sequoia and Andreessen Horowitz behind it. You have OpenAI that, of course, has gotten $13 billion from Microsoft, and you've got Anthropic, $4 billion from Amazon. So you have kind of a choose your fighter kind of situation.
Yeah. It's also fun to think about, Elon Musk has this empire and how kind of the pieces flow, because you mentioned Grok as chatbot, that requires a massive amount of data to train on. And so it's interesting, like that'll come from X, but then I've seen these reports, they're also already thinking, okay, how much data will flow from Tesla at some point too?
Right, and you've got OpenAI, which is forging different agreements with different news organizations and other sources to train its model. So it's very interesting. And I don't know if the quality of what they come out with, of the Gen AI that they come out with, is going to depend on where they're drawing the data from.
No, it's a great point, because is the data that's going to train Grok, that fuel, a lot of it's going to come from X. Is that good data? We'll see.
I don't know.
Ask it some questions, ask some questions, see what you get.
People have been asking all of these questions, like asking Gemini questions and stuff. They've been getting some wonky answers.
Yeah, wonky's a nice way to put it.
Glue to make pizza, anyone?
All right, we'll stick with Elon Musk-led companies. Tesla shares heading the other direction today. That's its proxy advisory firm Glass Lewis has recommended that shareholders reject a proposal to reinstate CEO Elon Musk's pay package. And Yahoo Finance's very own Pras Subramanian joins the show. Now, he's been tracking the story and has the latest. Pras.
Hey, Josh, how you doing, man? So, let me fix my collar over here. So Tesla here wanting to sort of have their shareholders approve Musk's 2018 pay package that was sort of rejected by a Delaware court. Now, what's happening now is Glass Lewis, the proxy advisory firm, says, you know what? Don't approve that pay package for Musk. It's just too excessive, right? The amount of stock that he is getting is excessively dilutive to current shareholders, more so than other pay packages that we've seen for the sort of mega cap tech companies, but also Fortune 500, S&P 500 auto companies. No one is seeing that kind of pay package here. Musk would argue, well, you know what? I'm not actually getting a salary here. Look at what the stock has done over the past 5 years. I made a lot of money for a lot of people. Why can't I get that pay package, which was, by the way, in 2018 approved by stockholders? So that's sort of the crux of the debate here. Glass Lewis saying that it's not good for shareholders. Neither is the move from Delaware incorporation to Texas incorporation. Doesn't really make sense. There's too much uncertainties with Texas business law at this point. So they're saying stay in Delaware. Musk, don't get that pay package. And oh, by the way, he's claiming that he wants at least 25% of the stock holding in Tesla. Always going to pull out AI and robotics and things like that.
And Pras, the meeting is what, June 13th, correct? So we've heard from Glass Lewis. Who have we heard from, and are there any big players that we're sort of waiting to hear which way they're going to go?
We've seen a number of smaller shareholders some small pension funds, some other types of funds that have said, we're not going to approve this pay package. They put together a letter last week saying that. And I think this did a slow drumbeat here of those sort of concerns. And of course, Glass Lewis, a bigger player in the proxy advisor world, saying that this is not a good pay package. But we're not surprised that Glass Lewis and probably ISS will come out at some point and say the same thing. But I think the big sort of concern is, what is the Fidelity's the world going to say, BlackRock? Are they going to say anything? I doubt it. It's going to be up to the smaller shareholders, I guess.
And Praz, I'm very interested to get your take on this. Let's say shareholders rejected that pay package. What do you think Elon Musk's response would be? I'm honestly not sure. I don't know if he would say, you know what, who needs this? I have other areas I could put my focus on, right? I got SpaceX, I got Julie and I were just talking about XAI. Or is it no, like he's just, I can't think of another company where the founder is so embedded. Tesla is Musk, Musk is Tesla. What do you think his response might be?
He hasn't gotten paid, believe it or not, since 2018, but his current holding of stock around 12 to 13% has seen that sort of his stake in the company, the value that go up tremendously. So he's not like he's suffering here. Do I see him leaving the company? I don't know. Maybe he steps back a little bit. Maybe he does follow through on that threat, and XAI and what you were talking about earlier, and other of those companies get more of the attention from the AI and robotics point of view. It's hard to say what he might actually do because he's such a mercurial character that from one whim to the next, you don't exactly know where he's going to go with that. But from a Tesla point of view, I think he knows that it's too valuable for him to, if he left, his stock holding the shares would go down, right? So I think he knows he's got to stay there, stay put. Maybe you'll actually see a more balanced pay package from the board, which seems like right now it's just rubber stamping a lot of what he wants. That's for the impression that a lot of people have. So it's hard to say, but you never know with Musk. You really never know with that guy.
You never do. Always makes your beat interesting, Pras. Thank you.
Thank you.
Checking in on another trending ticker today, Insmed. This is not one we talk about frequently. It's a biotech company that announced positive results from a study of a drug to treat a rare lung condition that is called bronchiectasis.
You said that much better. I'm glad you took a swing at that one.
So basically, this is a lung inflammation, and it affects, not a huge amount of people, but enough that analysts are very, very positive after seeing the results of this study.
Yeah, I was reading just in terms of Thailand, Julie. Company apparently plans to file for U.S. market clearance in the final quarter of the year, then launch in mid-2025, followed by launches in Europe and Japan. Analysts seemed very positive. Yeah. I saw a J.P. Morgan analyst quoted as saying the findings are a home run scenario, say they see the results as transforming the company and unlocking a key driver of value. And it sounds like investors were plenty excited too.
Yeah, reading between the lines here, some of the other analysts, one at Mizuho, said that this should provide a huge sigh of relief for investors as we believe it helps to secure a more positive outlook on the company's future. So obviously there was some concern over that. The company has never turned a profit, and it has been public for quite some time, about 10 years. The other possibility here, as the company says in its statement, is this maybe has the potential to address a range of neutrophil-mediated diseases. This is a certain type of inflammatory disorder. So there could be potentially other applications. That's kind of the model with a wide range of drugs. Now, you get it approved for one thing, and then potentially it can be used for others.
I saw another analyst also saying here the company does have a fair amount of debt, Julie, so maybe, I think their point was this rally we're seeing here gives them the chance to think creatively about some possible financing options too.
Makes sense. Yep. Well, let's stick with the healthcare sector, shall we? Because thousands of oncology professionals from around the world are set to gather in Chicago for the ASCO annual meeting, the American Society of Clinical Oncologists. There, a grid of sessions will reveal research, treatments, and visionary insights on cancer treatment. For more on what this means for the biotech sector, let's get to Jefferies biotech analyst Michael Yee. Michael, it is always great to talk to you, and I can think of no one better to talk to about this meeting. A number of companies have already released abstracts in advance of the ASCO meeting, as they tend to. So tell us, do you have a top one that you're going to be watching as we get more information at the conference?
Well, it's great to be here. Thank you. Good to see you, Julie and Josh. Obviously, the biggest cancer conference of the year in a week and a half. We'll be there. And it is true that much of the cat is out of the bag. Maris being one of those big movers this week, and all eyes are focused on some of the updated data at the presentation there. And a couple of others we're focused on, like Immunocore, ticker IMCR, and Moderna, mRNA, with an update on their phase 3 cancer vaccine or phase 2 cancer vaccine data. already in phase 3 with Merck. So those are a couple of the ones. I'm happy to talk about others. But of course, a big cancer conference of the year in biotech is moving and shaking, as it always is.
And Michael, quick question for you. Early in the show, I was talking to Julie about all things AI, and of course, we talk a lot of the show about how AI. Obviously, early days, Michael, but there is this real interest about how this technology could kind of upend and disrupt a lot of industries. And I have been reading some reports. There's already some talk about how AI could maybe reshape the field of oncology as well. Michael, any thoughts on that?
Well, look, first of all, there's only a couple of sort of pure play software platform AI related companies, Schrodinger, ticker SDGR, and Recursion, RXRX, which actually has a deal with Nvidia. So check that out. But a lot of the early investments have been going into a bunch of private companies. As you can imagine, the drug discovery process can take 10 years, and there is a wealth of discovery and work being done early on for new targets using AI and attempts at looking at large language models to discover new targets. But those are pretty early and certainly a risky, but most of them are private.
And before we dig into some of these names that you're talking about, and I'm interested in Maris in particular, which you mentioned, I guess for people who are not as steeped in this as you are, Michael, going into this meeting, I know this is a big question. Where are we in terms of cancer treatment and research, right? Kind of where are we on the curve of being able to treat most types of cancers? And is there anything sort of revelatory that you're expecting?
Well, you're asking an important question. And I think it depends on the time horizon of, maybe 10 years ago, it was all about chemotherapy and maybe new antibodies from Genentech like Avastin. Over the next 5 to 7 years, we now have been on the immuno-oncology IO wave, certainly with PD-1s and new developments across PD-1 and other immuno-oncology drugs, which has been fantastic. And now you're on the brink of also new modalities like CAR-T and other attempts at cancer vaccines, holistically like the Moderna cancer vaccine and others. And I think we're still looking for the next generation. I think the answer is that you're not going to have a one product, one pill cancer cure anytime soon, but we are making great strides over years to make big steps in cancer. And I think that when you, perhaps everyone's been spoiled and look at something just 5 or 7 years ago when we didn't have PD-1, and now you look at the types of efficacy that PD-1 has brought for us, I think we'd all be pleased. Sometimes maybe our hurdles are just a little bit too high, and we're trying to find a cure, but it takes time. But we have been making great strides, and that's why, Julie, that people are all focused on the thousands of cancer drugs at the ASCO conference and investing in biotech, and why all these IPOs are going out is because there are great promise over the next 10 years.
So let's get to Maris then. And this company specifically came out with the results of a study in head and neck cancer. MRUS is the ticker on that one for people who are not familiar with it. Now, the stock surged. It has since come back down a little bit. It hasn't retraced all of it. Like, how should people think about trading a stock like Maris around an event like this when it, because it already came out with the abstract from its study?
Yeah. Well, look, I think that in many respects, we try to think about buying stocks in advance of all of that. And Jefferies has been buy rated and been bullish on that going into it. The data played out in the abstract and then in the early presentation that they hosted this morning with more data. And the stock obviously has gone up over that time period. And now we're at a new step where obviously they're going to start phase 3. I think most people would think about trading this as we have great data as they move forward into phase 3, whether it's a potential takeout target or obviously one of the more promising drugs in head and neck cancer. I don't think we'd be trying to day trade that, but rather say that this is a very promising cancer company going to phase 3 and could be a takeout target.
Hey, Michael, can I squeeze one last one in? Because I'm curious to get your take on this. Besides AI, Michael, I'm not sure there's another trend we talk about more than GLP-1s. In your opinion, Michael, still a mega trend, hot as ever? And if so, are there ways to play it besides Eli Lilly and Novo Nordisk?
Sure, great. So we have said specifically that these types of waves come once in a decade or two. We believe that the GLP-1 wave is still relatively early in the multi-year cycle. We believe, obviously, that Lilly and Novo, as you've talked about, specifically Lilly, is obviously attractive and going to be a major player. We have said Amgen is one of the most important larger cap companies that we have been very bullish on, and they too will go to phase 3 with a monthly GLP-1, and we think the data is going to be great at the end of the year. There's also smaller companies like Scholar Rock, SRRK, or Corbis that also have new modalities that are interesting. And so a lot of these smaller cap companies, I think, are promising because the upside potential for that data in a $100 billion TAM is great, and the M&A potential for these is great. And we still think we're relatively early in the cycle.
Michael, terrific to have you on the show. Thanks so much for joining us.
Thank you, guys.
Coming up, there may be reason to be optimistic in the war against climate change. We're going to tell you more on the other side when market domination returns.
Since last year, the average person has seen nearly a month's worth of extra hotter than usual days, and those additional abnormal days can be attributed to human-caused climate change. That's according to a recent analysis from nonprofit Climate Central. But not all hope is lost, at least according to my next guest. He says there is reason to be optimistic in the war against climate change. Climate investor and activist Tom Steyer says there is reason to be optimistic in that war. He outlines the state of play in a new book, Cheaper, Faster, Better, How We'll Win the Climate War. And he's joining me now in studio. Thanks so much for being here.
Julie, thank you for having me.
I read that report today about those hotter days, and it is just the latest in a long line of really depressing news. And we, anecdotally, we see these reports in the news every day, right, about weather events, et cetera. Why are you optimistic?
Well, let's start. I want to start by confirming everything you say. The news from the natural world has been consistently not just bad, but worse than expected. And in fact, this is the hottest planet that human beings have ever walked right now. But people don't always know that. But what they also don't know, which I know as a result of spending my time professionally investing in companies that are leading the counter-revolution, is that the technology is better than anybody knows. That not only have solar and wind come down in cost and are really spreading quickly, but that the cliche in the climate world is we're not looking for a silver bullet, we're looking for silver buckshot. Lots of companies addressing lots of problems that can win in the marketplace on their own because they are, in fact, as my book says, cheaper, faster, and better. Let's win in the marketplace. We can do it, and we need people to get together and make it happen.
Where are we on that winning in the marketplace, right? Because one of the other things that you talk about is sort of getting society on the same page. You talk about, and you talked about in the Q&A accompanying the book as well, about the effort around World War II and victory gardens and this sort of sentiment of everybody being on the same team, pulling in the same direction. Doesn't feel like that right now, and it's hard to get people to make daily changes. They want everything to be perfect without having to do anything.
Well, let me say this. We're not asking people to sacrifice economically. As I said, if it's not good enough to win in the marketplace, it's not going to happen. But let me give you an example of something where whatever the talk is, we can see what's really happening, and that's Texas. If there's a state where the elected officials have disliked the idea of renewable energy, have disliked the idea of whatever ESG is, it would be Texas. Texas has tripled its amount of solar in the last 3 years and expected to go up another 35% this year. Texas produces more wind energy than any other state by far. Are they doing that to be nice or to be woke? No, they're doing it because it's cheaper. And when we look around the world, what we're seeing is these new technologies, and this follows technological breakthroughs for the last 200 years. They spend a lot of time reaching cost comparability, and when they break through and are cheaper, faster, and better, they go straight up. It's described as an S curve, and then it flattens out. That's what we're seeing in a lot of technologies, not just solar and wind, but EVs and heat pumps and other things.
As you talk, I have to ask you about nuclear, because there's been a resurgence in interest in nuclear and sort of acceptability of nuclear. Where are you on that technology and what role it needs to play in all of this?
Well, first of all, there are two different kinds of nuclear, so let's try and separate the two. There's the existing technology that's been around, which still has plants in the United States. That's fission technology. People are trying to build smaller, safer fission reactors, and we'll see if, in fact, they can be both safe and cheap. I mean, the real problem with nuclear fission has been no one's been able to build a plant in the United States for a reasonable price for a long time. And so people think nuclear is somehow cheap. It's very, very expensive right now. Right. The other kind is nuclear fusion. That is a new, very difficult to achieve engineering feat. People have been saying, and I've talked to, there are probably 12 big companies trying to solve this. I've talked to the CEOs of 2 of them in the last couple of months, and they say, if everything goes great, we'll be meaningful in the market in 2040. That's 16 years away. We really don't have 16 years to wait. Right. If it comes, that's great. But we need to focus on the next 10 years and really get things going. So as far as I'm concerned, when we think about new electricity generation, that's not the place I'm looking to solve the shorter, intermediate term problem.
Speaking of urgency, this year is a presidential election. You are a supporter of President Biden. You've held fundraisers for him. What do you think, conversely, a Trump presidency would mean for climate change and climate change policy?
Well, I think one of the things that I've been trying to say is that clean energy is winning in the marketplace. And it's kind of, you can say whatever you want as a politician, but if something is cheaper and better, people are going to buy it regardless of what you have to say. That's going to go on in the United States, I think, regardless. I think the big question for the United States is that under a Republican administration, we are not going to do the kind of international leadership, international cooperation to build the kind of global institutions and measurement systems so that, in fact, we can have a global response to what was once called global warming. This is a problem that concerns everybody on the planet, and we're not going to have the kind of cooperation that's necessary in coordination without American leadership. It's not like we're the only country, but we're an indispensable country. And if that, in fact, the Republican administration pulls back, as it did under the previous administration, and as they're saying they're going to, then the kind of leadership that we need and cooperation with China and India and the rest of the world won't happen. And that means that there'll be a delay in terms of building those international systems of cooperation, measurement, and standards.
What about even domestic legislation? I mean, former President Trump reportedly met with a bunch of oil executives and said, I'm going to get rid of the IRA if you guys support me. Now, I've spoken to some oil executives, and they say they don't like the inconsistency that we have seen in policy, right? That everything flips every 4 years. Do you think he'd even be able to get rid of the IRA if he indeed wins the election?
I think most of the IRA is stuff that has been deployed or where people have pushed to get things done so they can't be reversed. I think most of it is in red states, and it's created a lot of jobs. Mm-hmm. So I believe that in the United States, we are rolling. And yes, there will be different speeds, and maybe some of the new technologies will be slowed down because they won't get government support. But by and large, the United States is heading on a glide path that has been laid out by the Biden administration, and I think that it'll be slower and faster, but we're really going to get there. We are going to win this whole thing. Let me say, Julie, people think two things. They think we're an oil and gas country and we can never get off it. That is absolutely not true. We will get off it. It's a question of how fast.
Right.
And the second thing is people think we're in a climate doom loop, that basically we're destroying the natural world and we can't stop ourselves from doing it. And that is false. What I'm trying to say is this. Yes, this is a crisis, and it's probably a bigger crisis than most people understand. But it's really a challenge for us, and that's how we should think about it. This is something we will win. We will win it together. Inevitably, this is going to happen. The question is, the sooner we pull together, the sooner we work together, and the sooner we recognize that we're really all trying to make a better world for the future, a safer, better world. The sooner we recognize that we all want that same thing and just decide how best to do it, that's when I think the United States is going to step up and do what we've traditionally done, which is solve the big problems.
Right. I mean, it seems to me that's the tricky part, right? I mean, again, going back to the election, how many people, for example, are voting on this issue? It doesn't seem like, I mean, people are voting on inflation right now. They're not necessarily thinking about climate as their biggest issue.
I think that's true. And I think that one of the reasons I wrote this book was to say to people, this is something that really is important. This is something that really affects you. Most Americans agree with me, as you said. I mean, most registered Republicans agree with me. They just don't prioritize it.
Right.
What I'm saying is, this is not just something we have to do. This is a great opportunity for America to do the kind of things that we have done in the past, that we were really built as a country to do. And that involves accepting each other, not villainizing each other, but really coming together and solving big problems. That's what we do best, and that's what we're proudest of ourselves for.
Tom, thanks for being here. The book is Cheaper, Faster, Better: How We'll Win the Climate War. Appreciate your time.
Thank you for having me.
All right, let's switch gears and back to our market business, if you will, and talk about some calls of the day here. We start with Dell Technologies, which is getting a price target lift from Loop Capital, the firm citing legitimate Gen AI progression. And it's interesting, the sort of evolution, if you will, or the migration and perception about Dell, which, you know, people think of as a PC company and a server company to some extent, Josh, but lately it's had this Gen AI buzziness. You know, it also had a conference recently. Jensen Huang of Nvidia was there, so it's been an interesting shift.
Yeah, so they rate Dell a buy. They raised their target to 185. And to your point, Julie, they say, you know, their work continues to show legitimate Gen AI progression in the last 90 days. They do note some risks to their call: Gen AI server revenue, the PC refresh cycle, valuation. I mean, the stock has enjoyed a remarkable run. It's up more than 250% over the past 12 months, about 120% just this year. So investors love it. The street loves it.
Yeah, and it's interesting what they comment on in this, saying that it's very well positioned for long-term commercial IT budget wallet share.
Yep.
I've seen a lot of talk about wallet share recently, these enterprise software and hardware notes that, you know, where is the money going to be flowing? And we've talked about a lot of it's going to flow to Gen AI, to the infrastructure. And I guess Dell is now part of that infrastructure. And so that's part of the thesis here.
By the way, it is showtime. Dell reporting its Q1 earnings this week, May 30th. So we'll see.
We'll be ready.
Yeah, we are ready. All right, Morgan Stanley, meanwhile, sending a cautious tone on Celsius Holdings, noting sales growth for the energy drink maker appears to be slowing. So you saw the stock getting hit today on that. And Morgan Stanley's basically saying, Julie, sales growth for the company slowed sequentially in the 2-week period ending May 18th. Looks like they're citing kind of industry sales data here, and I'll say sales growth slowed to 39% year over year in the week ended May 18th, and that's down from 50% in the week ended May 4th.
Those shares have been, as Josh Lipton would say, a rocket ship this year. They are up around 50% here as we have seen the popularity of these drinks really expand. One of the other things, and take this with a grain of salt, there is a little bit of sort of social media chatter because there are sort of one-off reports at times about the health issues of Celsius. There was a recent report about a guy from Chattanooga who drank 2 a day and had liver damage that he said his doctors attributed to the quantity of Celsius he was drinking. I guess the thing says you max out at 2 a day, although I can't imagine how I would feel on 2 Celsius a day. But, so that stuff kind of percolates through as well. And
it does, but to your point, Julie, even, the stock got hit on this today, but even so, even with this, it's still up like 40% this year, and most analysts still think you should buy it. Not Morgan Stanley, but most are still saying this one's a buy, even at these levels.
15 buys on the stock.
Yep.
All right, coming up, we've got a slew of retailers set to report their quarterly results this week. We'll take a look at the best ways to invest in the sector with today's playbook. That and much more when Market Domination returns.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
All eyes on the consumer this week. A slew of retailers like Abercrombie & Fitch, Costco, Kohl's, they're all set to report their quarterly results, providing insight on customer spending. This coming as consumer confidence saw a rise in May, while recession concerns still linger, according to the Conference Board. And we're looking at how to navigate the big picture with the Yahoo Finance Playbook. Here to discuss, Barclays consumer discretionary analyst Adrian Yee, along with TD Cowen analyst Jonah Kim. Thank you both for being here. Appreciate it. Guys, I want to start big picture first, right? Because it's a confusing time when it comes to consumer, right? You got consumer confidence, they rebounding, but you have a lot of the retailers talking about a trade down effect, et cetera. When we're talking about these specialty retailers in particular, the likes of an American Eagle, an Abercrombie, a Gap, for example. Adrian, I'll start with you. Kind of how are they sitting with the consumer? What share of the consumer's wallet are they getting these days?
I would say that this is an ebbing tide. We are year to date in what I call a consumer malaise. Clearly, you're seeing a pullback. The inflationary impact is now impacting not only the low-end 50K consumer, but it's starting to have a creeper effect, right? It's coming up to the 75K and even to kind of the higher household incomes. So what I would say is you have to have a trend or a brand that rises above. This is the 80-20 rule, right? 80% of stocks that are in kind of the subsector, they trade along with kind of what I call the micro macro. And you've got to find, our job is to find the 20% that have some halo moment on them. American Eagle, this whole silhouette shift that I've talked to you about, the denim bottoms and the kind of fashion change that's going to happen in the back to school time period. I also think Gap is our other pick here. We don't cover Abercrombie, but they would fall into kind of the companies that have momentum. Old Navy is the key at Gap brand. They are the ones that are actually turning, and they are taking share in that lower end household income in their segment.
And Jonah, I want to bring you in here as well. Maybe start that same high level, Jonah. Just how does the consumer look to you, Jonah? How healthy, how resilient based on your coverage universe?
Yeah, the low end is definitely pressure, but we think the newness is resonating a lot with consumers. At Bath & Body, which is our top pick, they have a new Netflix partnership. They're venturing into men's and laundry. So there's a lot of new categories there. And we like the new balance that they're having in stores. So any newness is resonating quite well. And another differentiator is proprietary products, and HIMS is another concept that we really like. And that proposition is products that are affordable and differentiated from other platforms. So those are the key to a strong consumer sentiment, in our opinion.
And Jonah, I want to pick up on what you were talking about with the price point, right? That value is also an important component of this. And I wonder sort of, how does value now compare to value last year or 2 years ago? I mean, how much are consumers prioritizing that?
Yeah, I think we are seeing a lot more choiceful consumers. So they're prioritizing value while also being very selective in what they can spend. So as I mentioned, having that newness and differentiating factor, in addition to having strong value proposition, make strong sense for consumer at this stage. That's sort of how we are seeing a consumer today.
And Adrian, and same to you, because that is a theme we hear, Adrian. You know, if you're trying to pick on kind of trends you hear, it seems to be this consumer who is generally more cautious, more prudent, kind of focused more, Adrian, on right now what they need rather than what they want.
I would say that's absolutely the case. Let's remember that, compound inflation over the past 5 years is up, close to 20%, about 18%. Within kind of just apparel and accessories, once they went through the purging process on the inventory, the average unit retails, right, the out-the-door pricing, inclusive of prices that they took up, right, during the 2021 time period, are also up about 15 to 20%. So people are paying significantly double-digit more than they were in 2019, and we're starting to see the ceiling, get hit on those price points. We're seeing a ton of promotions. Memorial Day was about as promotional as we've seen it. And I don't think people made plan over this past weekend, generally. So we saw a lot of extensions. And I think you're just going to kind of fight through kind of the summer time period until we get to the back to school season. And then we have reason and need to buy.
And reason and need to buy where is the question still. So, Jonah, you talked about that BBWI is your preferred stock right now, but we're also getting Gap and American Eagle this week. So just quickly tell us what your stance is on those two going into the numbers.
Yeah, on American Eagle and Gap, we are market perform. We see strong momentum in both brands. Obviously, Gap is having its moment with the fashion show and others. So we are seeing a lot of momentum there, but we are just a little bit more cautious on the execution and longevity of growth at both Eagle and Gap, especially Gap Athleta really needs to turn around. In our opinion, Old Navy is an important concept, but I think there's still a little bit more focus on Gap brand at the moment. So we are waiting to see more stability in the financials. And also Eagle has done very well. We do need to see a little bit more, I think, strong signs at Aerie and Offline and American Eagle. And to our point, there is a little bit of cautious consumer dynamics playing here. So we remain cautious, but our pick is Bath & Body. We like the newness and we think promotions are well controlled. And they have 37 million loyalty members that they can continue to leverage. So there are a lot of new exciting initiatives at Bath & Body Works in our opinion.
And Adrian, you gave us your thoughts on Gap. What about American Eagle as well? It's a stock that's had a nice move already, Adrian.
So American Eagle, we think that they are absolutely in the bullseye of this kind of silhouette shift with the, 40% of their sales at American Eagle are actually in denim bottoms. And they are kind of the lone teen player from like 10 years ago when we had Abercrombie, Eagle, and Aeropostale playing in the space. Our promos kind of throughout the quarter and sort of quarter to date, they've held in there. Right. So we hate to see deeper promos and we see them hugging the promos that they did last year. To us, that kind of says that they're on plan and they should be OK. No one's going to blow away the quarter. Right. So the best you can hope for is a little bit of upside, probably driven by SG&A for the quarter, a blessing of the Q2 guidance, maybe a little pass through to the year. And that's all we need.
Oh, here we go.
Sorry. Go ahead, Adrian. I think we're having a little sound problem with Jonah.
Oh, no, I was just saying that a little bit of a beat, an inline guide, and a pass through to the year, a little modest pass through. That's a heroic. That would be a really good print for us.
All right. Thanks so much, guys.
Adrian, Jonah, thank you both for joining us today. Appreciate it. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including earnings from Kava. And at 4:30 Eastern Time, it's the latest edition of Asking for a Trend. I've got you covered with the biggest market-moving stories affecting your money. Stay tuned. More market coverage after this.
And that's the closing bell on Wall Street. Now it is market domination overtime. We're joined by Jared Blicker to get you up to speed on the action from today's session. Let's start with where the major averages ended up or down, as the case may be. In the case of the Dow, down by about 217 points, off about 0.6% on the day. The S&P 500, little change, but very slightly to the upside, it looks like, as we close out here, and the Nasdaq higher by about 0.6%. We saw the likes of Nvidia helping to buoy that particular index here today. Interesting that we've got the equal weight index of the S&P down by about 0.8%. The Russell 2000 down about 0.25% here. As we talked about earlier, and I just want to highlight again, this move back upwards in the 10-year yield, perhaps a little bit of a stumbling block as we await Friday's inflation data. Now let's send it over to Jared, who's got a closer look at today's action.
Julie, I'm really interested in the 10-year today because we broke above 4.5%, and that was done on that 1 p.m. auction. We have several more bond auctions this week, so that's going to be front and center. When it comes to sector action, when you see higher yields, you don't think tech should be outperforming, but that's what happened today, along with communication services. But energy was a big winner here. Energy up 1%, tech up 44 basis points, communication services 19, and then you have industrials down over 1%, so is healthcare and financial. And just taking a look at some of the leaders today, it was really all about the chip stocks. I'm going to go straight to our semiconductors, where we have Nvidia in the midst of a 3-day rally that is worth, let's see here, 20%, just over 20%. So that's really impressive to see that following their earnings, and also seeing some follow-ons by AMD, ASML, each of those up more than 3%. ARM up almost 9%. So that's where a lot of the action was, but we also saw energy really take the leadership position here. Exxon up over 1%, so is Shell, so is ConocoPhillips, so is BP. So we are seeing that strength, and it's been interesting to track energy versus tech. Usually when one of them is leading, the other is lagging, but today they both happen to be in the leadership positions. I'm also going to check in on our travel section, and we're seeing a lot more red here than green. Delta Airlines down 3%, but Carnival bucking the trend, up more than 3%. And in fact, the cruise line's doing pretty well overall. Norwegian Cruise Line's up over 3.5%. Guys?
All right, thank you, Jared. Stocks closing the day mixed as investor attention turns to inflation data this week, but today consumer confidence came in and showed a rebound for the month of May. Our next guest says it's important to not ignore consumer data. For more, let's welcome in Alex McGrath, North End Private Wealth Chief Investment Officer. Alex, it's good to see you. And maybe let's just start there, Alex. You know, U.S. consumer confidence did unexpectedly rise in May. What'd you make of that, Alex? And what do you just make of where the consumer is right now?
I don't take a whole lot away from the consumer confidence reports, simply because I don't know exactly who you're asking on a week-by-week basis, and maybe the next batch isn't as strong. But to us, the consumer is really the driving force of GDP, and with as your last guest were just saying, with everything across the board starting to cost 30-40% more than it did 4 years ago, credit card balances at all-time highs. You've got interest rates where they are is causing debt load management problems. Where that consumer ends up is really going to be the driver of where we go from a GDP standpoint, and that's why we think it's the most important thing we're trying to monitor right now.
And so the things that you're monitoring, what conclusion are you drawing right now, Alex, as to where the consumer's going?
Well, I think we talked a lot in 2020 about a K-shaped recovery, right? Where asset owners ended up far better off coming out of that recovery than the bottom half of the K did. And I think we're almost kind of looking at the exact same thing here, where, if you're above a certain line, this inflation pain point isn't nearly as important to you if you're below a certain line. And so I think that's where that starts to feed into itself, honestly.
And Alex, the Fed officials, they keep talking today too, right? Neil Kashkari was on another network, says policy stands restrictive, but clearly not ruling out another hike either. What do you make of some of those comments, Alex?
We don't think another hike is on the table, but we've, kind of morphed into this place where I don't think a cut's coming this year either, which is obviously a gigantic change from where we were in January, where for some reason the prediction was 6 cuts. And when we thought through it and we were looking at it from an allocation standpoint, it really came down to the macro data at that point in time was far too strong to support anything of that nature, other than, we said we're going to do it, so we're just going to do it. So we don't believe that there's a rate cut bonanza coming for us at the end of this year, unless, something in the interim goes horribly wrong.
And so, given that you've had that view for a while, so how have you been playing it? What's the best way for investors to sort of, if that's the framing, then what do they do?
So certainly from a fixed income standpoint, if you think those rate cuts are coming, the best way to take advantage of that is to ladder in duration on your fixed income portfolios. And truthfully, that was something we didn't do. We've tended to stay on the short end of the curve and the floating rate and super short duration, just because, as everybody with a money market account has realized over the last 2 years, you're getting paid on those short-term accounts, and not taking any of the volatility that you're going to see when yields scream higher or scream lower. So to us, it's maybe we're giving something up in the long run, not going ahead and taking those positions, but we're very, very happy to wait and get 5.5%, 6% without taking a lot of the yield volatility.
What about commodities, Alex? They've caught a bid. So I guess two questions. In your opinion, why and how, if at all, you play in that?
That was a big benefactor in the CPI and PCE numbers looking the way they did in 2023. And all of a sudden that's come roaring back up, which is going to ultimately make that inflation number, really sticky where we are. Could drive it a little bit higher if commodities keep moving. But, it kind of enters into this, I hate to even say it, it's like stagflationary environment where growth is beginning to moderate and inflation's not going anywhere. So, that's typically a scenario where commodities are a great thing to own. And, when we do that, we do it via ETFs and mutual funds. We're certainly not out there, flipping soybean futures back and forth.
But and can I just ask you guys, which ETFs exactly?
I'm not certain I can give out direct recommendations on that, so let me hold that one there.
Well, in general, though, would you be buying commodities, whatever way you're doing it? Is that something you'd be holding?
Yes. Yes, we would be.
Okay, sounds good. Alex, thanks a lot. Appreciate it.
Thank you.
Well, the first former FTX executive since Sam Bankman-Fried got sentenced to more than 7 years behind bars. We'll have more on that and more on a jailhouse interview with SBF himself. More market domination overtime coming up. Former FTX executive Ryan Salem has now been sentenced to 7.5 years in prison. That term longer than the defense or the prosecution had asked for, and indicates how tough the judge will be toward perhaps other members of Sam Bankman-Fried's inner circle. The sentencing comes as the FTX co-founder himself reportedly awaits transfer to a California facility. William Cohen, founding partner at Puck News, spoke with Bankman-Fried earlier this month. He joins us now, and you spoke to him in prison. And you wrote about that for Puck News. And what's fascinating to me is not just the conversation you had with him, but the whole process is really interesting, Bill. So welcome, first of all.
Thank you. Great to be here.
And tell us about that.
Well, you know, it's a beautiful day out here in New York today, and it was that kind of similar day on May 7th. You can only visit on Tuesday, and this is in Brooklyn at the Metropolitan Detention Center, which is in Sunset Park, a part of Brooklyn I'd never been, and not many people really, you know, hang out there. You know, there's two monolithic buildings. You know, of course, I went to the one, you know, that looked more inviting. That turned to be which is sort of where most of the men are kept. But it turns out he was kept with a group of 35 men in the women's side of the prison. So I had to go back over there, but because they're understaffed, they didn't let you in at the appointed hour that they're supposed to let you in, so we all had to sort of wait around. Anyway, I got in there eventually. It was quite a challenge, and then ended up talking to him for about an hour and 15 minutes. He just suddenly, we were in this cafeteria area, which was sort of bright and cheery and welcoming to families. And then out of the corner of my eye, I saw Sam in his chocolate brown jumpsuit, you know, noticed the hair looking much thinner, and sat down and we just talked for an hour and 15 minutes. Couldn't bring in any recording device.
That is rough. And not even a pad and pen, Bill?
No pad and pencil, not a pen, just my brain, which, so I had to focus on what he was saying and focusing on the remembering.
Yeah. And how did he, I'm just curious, but did you get a sense, like, just how he seemed to you? What was his mood, to the extent that you could kind of read it?
I mean, look, I would have thought that it would be an incredibly depressing experience knowing that you're going to be in a place like this for 25 years unless there's some degree of leniency. I mean, maybe it's obviously early days. He's been there since August. He's only been, you know, convicted since last year, and his sentence was in March. So I actually found him in better spirits than I thought he'd be, quite honestly. He said that he's actually been treated pretty well, which, I mean, or at least not badly, you know, because we've all seen the, you know, prison movies. We know sort of the gestalt of prison life. It's probably not something any of us would want to experience. But he seemed, you know, pretty good frame of mind, frankly. I'm a little surprised. I mean, he talks to his lawyer and his parents, who were probably also acting as lawyers, you know, former Stanford law professors, you know, for at least an hour a day. He plays video games, watches movies on a tablet that they give him that's not connected to the internet, and he's also sends, you know, emails through core links. So I'm sure it's not great. I think he's, you know, I'm sure he feels like he's wasting his mind there, but you know, this is what he's got right now.
Well, his mind right now seems also really focused on an appeal process.
Totally.
So, I mean, do you feel like, Bill, is he in denial? Does he strike you as a person in denial? I mean, the whole world has a certain perception of this guy, I think fair to say, or most of the world. And he pretty steadfastly has said, like, he didn't mess up.
Yeah, I mean, actually, at one point I said to him, do you feel finally like you were being punished for something that you did wrong, and you know, maybe the sentence was too long or was unfair, but you really did feel like you did something wrong and you're willing to admit that, and now you're getting punished for it? Or do you feel like you're in here unfairly and you're being punished for something you didn't do? Councilor Priest, I think it was the latter. He still maintains his, you know, innocence, that he did nothing wrong.
So no real sense of remorse there, Bill?
No, I have to say. I mean, he's not adamant about it. He's not like pounding the table. He's not, you know, emotional about it, because I don't think that's his nature. But he definitely feels like he did nothing wrong. And
well, that's been the argument, right? I sort of like, you know, I made a mistake, but it wasn't
wasn't criminal.
Right.
It wasn't gross negligent. It wasn't negligent. You know, it was if they had just let me, and he blames Sullivan and Cromwell, of course, and if they had just let me, continue raising the money that I was trying to raise when we had the liquidity crunch, it all would have worked out fine. You can see now everybody's getting their money back. The investments that I made were actually fine. It was just a time period where they just went to town on me and tried to, the perception was the boat was sinking, every man for himself, and, who gets thrown off the boat or, puts in irons first is the CEO. And, I think that's what he thinks happened to him. Yeah. Everybody else got to cut a deal, including Ryan, including everybody else that reported to him. S&C, he claims went to the Southern District of New York and sort of reported on him and in an effort, potentially to save themselves and keep them out of any potential litigation. So I think he felt like he was quite lonely and that they were gunning for him and wanted to make an example of him.
I want to switch gears
Yes.
to another thing that you've been writing a lot about recently. Maybe on the subject of self-delusion, maybe not, I don't know, media executives. You have been looking into that world a lot, and there's obviously a lot of action there with Paramount still being in place somehow, and some of the troubles at some of the other media companies. What's kind of your big takeaway as the landscape right now? And how you always, one of your real talents, Bill, is you have like an ear for these types of executives or these characters, right?
Well, I'm very character-driven kind of writer, so I love it when I find a great character.
Yeah, so how are these characters in media feeling right now and facing these challenges?
I think that we've got, that's a big media, let's call it, not as opposed to like the tech media.
Right.
Big media, I think, is in disarray right now. Whether it's Disney or Warner Brothers or Paramount or, with the exception of, say, Netflix, which I guess is tech media. But
that's the one everybody else seems to be still trying to chase.
If they can, but their business model is like completely different. They don't have any of the legacy problems. As a former M&A guy, to watch, and I worked on, by the way, the original Viacom acquisition of Paramount back many years ago when I was at Lazard. And so to see this M&A process drag out so long and so publicly and so foolishly, it's just an amazing situation to me. You could ask yourself, why in the media are we so fixated on the Paramount story? It's just because I think, what Sumner Redstone built and then what Sherry took over and now what she's finally made the decision to sell, it's obviously the wrong time, the wrong moment. She can't find the right buyers, even though there's been some creativity. I give, the Ellison crew credit for creativity, and Sony Apollo, probably there's plenty of good ideas coming out of them, but Sherry can just say no whenever she wants to, and nobody can do a darn thing about it. And everybody knew that they couldn't do a darn thing about it because she is the controlling shareholder with the voting stock. So, and meanwhile, the stock continues to tick down. It's just a sorry situation. And people like, Mario Gabelli, I don't know what he was thinking owning that stock for decades now. He's not going to kind of get the payday that he wanted. And he's a smart guy. So to me, it's fascinating. It really is.
Even if there was a deal, Bill, what's your sense of what they could do with Paramount that maybe Paramount couldn't just do on its own at this point?
Yeah, well, obviously, the Ellison crowd has a lot of interesting ideas, and they're going to bring in a whole new management team and focus on the studio, marrying it with Ellison's studio. Sony and Apollo, who obviously is the owner of this
yes, indeed.
network. I think they have a lot of my sense is a lot of interesting and creative ideas. It's probably more of the, cut and peel off assets strategy and, really reshape the business. With the Ellison deal, that would remain, Paramount would remain a public company. So, investors who obviously won't get the kind of payout that Sherry will get if that deal will happen will have the opportunity to participate if, David Ellison and company are able to, turn that company around. But it's so small on a relative basis.
Yeah.
Comcast is 250 billion market cap. Disney's about that. Netflix is 400. this is what, 10 billion?
But it's drama, Bill.
Oh, it's great.
It's drama.
It's great drama.
Succession's over. We need something to watch.
We love the drama.
So there we
doubt
go.
About it.
Bill Cohen, good to see you. Thanks for coming in. Appreciate it. We got some breaking earnings news that we want to bring you from Cava, the Mediterranean casual restaurant chain, coming out here with first quarter revenue at $259 million, beating analyst estimates of about $246 million here. And earnings per share handily beating estimates as well, coming in at 12 cents. EBITDA also beating estimates, comparable sales in the quarter up 2.3%, and the company for the year is saying comparable sales will be up 4.5% to 6.5%. That is above what analysts had been estimating, and yet the shares are down.
Yeah.
Which I just saw after I read all those numbers that seemed pretty positive.
It is. I mean, you watch this name, and particularly because obviously it's that same store sales. That's obviously a big key metric. And, you're looking at these names for any kind of more signals of what we've been talking about on the show, which is kind of the more budget conscious consumer. Also worth knowing, the Journal did know that Cava raised prices in January to sort of offset ingredient inflation. But of course, the company knows consumers, as we were talking earlier in the show, they are feeling more stretched. They had said no more increases were planned this year.
Also, of course, you got to put all of this into context. The stock came public back last June. $22 a share.
Yeah, what a move.
It closed today at $82.40. There you see the after hours movement. The stock has already almost doubled again this year. So obviously there's quite a bit priced in here when we're talking about the reaction that we are now seeing in the after-hour session to these numbers.
That's just an amazing move for the stock.
Yeah. Good. Yeah. We know you haven't eaten at Chipotle. Have you eaten at a Cava?
I did try Cava. I tried. You know what? In the falafel, not bad.
Not bad. I like it.
I didn't know.
And I see here they're also following Sweet Green and rolling out grilled steak.
All right.
That's the hot new
Sounds
ingredient,
like a lunch date.
I guess. Yes.
All right. Oil traders await updates on output policy from OPEC Plus. The organization is set to meet on June 2nd. Here with the very latest is Yahoo Finance's Inez Ferrer. Inez.
Yeah, Josh, and analysts are expecting OPEC Plus to continue on with its production cuts past June. That's the expectation in the markets right now, and part of the reason why we've seen oil prices higher. Let's show you where those oil prices landed today, with WTI up more than 2.7%, settling at $79.83 a barrel. Year-to-date, WTI is up about 11%. Brent crude was up more than 1% today, settling at $84.22 a barrel. Year to date, it's up more than 9%. We have seen the U.S. dollar edging lower, and that's U.S. dollar is set for its first monthly drop in 2024. So a lower U.S. dollar will also send up the prices of oil because it's invoiced in U.S. dollars. But again, that OPEC Plus meeting is really the key driver of some of these gains that we've seen. It will be a virtual meeting. And the expectation is that, look, with Brent being on the lower $80 barrel range, OPEC Plus really wants it to be between the $80 and $90. It doesn't want oil to get too much near $80 a barrel. So the expectation is that they will extend those production cuts that are ongoing right now.
Inez, also a development in a story that you and I have been watching closely. We got the final results from the shareholder vote over the Chevron Hess deal. This was the Hess shareholders voting on this, and they approved it, right?
Yeah, that's right. And we have been watching this deal closely also because ExxonMobil has sent this into arbitration with ExxonMobil, saying that they have a right of first refusal in the Guyana stake that Hess has, and that's part of the main reason why Chevron was looking to acquire Hess because of that block, that prolific block that is in Guyana, which has been a great source of production for Hess, for ExxonMobil. ExxonMobil has a stake in there as well. But look, a Chevron spokesperson saying after this vote, we're pleased that a majority of Hess shareholders have voted to approve the merger, and that they anticipate moving the FTC regulatory process towards its conclusion in the coming weeks. also continuing to say that they're confident in their position on the preemption rights, that those will be affirmed in arbitration, and are working to advance the process on this straightforward matter. So Chevron is expecting to win by all accounts on this deal and to be able to close on the deal with Hess. We'll have to wait and see.
We will, because I'm sure Exxon thinks they're going to win too. So
yes.
We'll see what happens. Thanks, Inez.
Yeah. Thank you.
Some breaking news here. Robinhood shares are soaring after hours after the company said it is authorized a repurchase program of up to $1 billion worth of stock. Now, this is over a 2 to 3 year period starting from the third quarter. But nonetheless, I believe this is the first buyback that we've gotten from Robinhood. And the company says, according to Jason Warnick, the CFO, as our business and cash flow continue to grow, we're excited to announce this $1 billion share repurchase program to return value to shareholders. Pretty brief statement here, Josh, but seeing that pop in after hours trading.
Yeah, it's so interesting, Julie, just to see this sort of the transformation of Robinhood. You know, you initially thought of it as like commission-free trading, and now Vlad has them in credit cards and retirement accounts, and just the way their product portfolio has changed there. It's a fun story to watch, the transformation there.
Yeah, although it's interesting because it still largely trades on enthusiasm for things like meme stocks, right? It recently got a boost from that.
Sure. Yeah.
Bank of America's Craig Siegenthaler, who had been a longtime bear on the stock, double upgraded it. So that helped give it a pop as well. And the stock has done pretty well this year. It's up almost about 61%,
nice.
But it has never come close to achieving the dizzying heights it did after it came public, and there was the initial meme stock frenzy, right? So, but to your point about transformation, it's sort of grown up in a way, right? Like we have seen the maturation of Vlad as a leader. We've seen the maturation of Robinhood as a company. And it seems like something like a stock buyback is sort of the next logical step in that process.
To your point, what a move for this stock, 130% over the past 12 months at this point. Yep.
Yeah, it's a big one. All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Yahoo Finance's Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of that curve. Here are some of the trends we're going to be diving into. Consumer confidence is on the rise, but inflation concerns linger. We've got an exclusive look at consumer credit data to determine how it's showing up in spending. And Memorial Day travel hit record highs this weekend, but moviegoers failed to bring the heat to the box office. More on what the lackluster ticket sales means for theaters this summer and beyond. Plus, one of Wall Street's favorite recession indicators could break its winning streak here. We're taking a look at the off-sided inverted yield curve in our chart of the day. Consumers aren't just feeling better, they've got the credit to back it up. Vantage scores saw the average American's credit score improve from a month ago following a trend of declining delinquencies. Yahoo Finance has an exclusive first look at Vantage Score's latest data on consumers' credit. CEO and President Silvio Tavares joins us now with a closer look at the trends he's seeing. Silvio, it is good to see you. And it's a perfect time to have you, Silvio, because we're through earnings season, basically. We had a lot of different data points on the consumer, and investors are trying to get a hold of, Silvio, how healthy and resilient is the consumer right now? What are you seeing, Silvio, in the credit data you have?
Well, the good news is the consumer is actually very healthy and actually improving in overall credit health, Josh. Thank you for having me on. And as you look at through the end of April, the average Vantage score was 702. The lowest Vantage score is 350. The highest is 850. And 702 is a great credit score. And that's where we're seeing the average consumer come in. And it's not just that. It's not just the consumer is actually increasingly credit healthy. Banks are actually increasing their lending. And so we saw originations of new credit accounts, credit cards, auto loans, et cetera. We saw all of those actually increasing through the end of April. All good news, and makes it unlikely the Fed is going to cut anytime soon.
I want to get back to it because what it sounds like you're saying, correct me wrong, is generally things look pretty good, but there's some bifurcation here. And so I'm just interested to get some puts and takes there. Like what is Silvio elevating some folks higher into the sort of super prime, but pushing others out of that prime tier?
Well, like in all things, the averages sometimes mask two different realities. And that's certainly what we're seeing in the latest insights from our monthly Vantage Score credit gauge. Overall, as I mentioned, the consumer's credit healthy, and we've been actually very bullish on the consumer for the most part of last year as others were forecasting the untimely death of consumer spending. That didn't happen, and the data shows us that. So overall, very healthy average consumer. But there are segments showing some weakness, and certainly we're seeing younger, less affluent consumers under stress. Those consumers tend to disproportionately use credit cards. And for most of the other credit products, we did not see an increase in delinquencies, and certainly not compared to pre-pandemic levels. But credit card was an exception. There we're seeing consumers seeing increased delinquency rates, and delinquency rates are actually higher than pre-pandemic. And so those lower income, less affluent consumers are struggling. And we see that in the numbers.
And so you mentioned the banks. I want to swing back on that because what are the banks seeing right now? What do they make of this environment, Silvio, and how are they competing for customers?
Well, this is the big challenge right now because the Federal Reserve wants banks to be tightening credit, making less loans. And we're not seeing that. In fact, we're seeing the opposite of that. Banks are actually increasing their lending. And the simple reason is consumers have high average credit scores. Consumers are employed for the most part. And as you would expect banks to do, banks are making.
Silvio, I think we had some audio issues there, but we thank you for that time and that important data. Tech-heavy Nasdaq reaching record highs as the benchmark S&P 500 finishes the day just above the flat line. Here were some of the trading day takeaways as Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh. Yeah, so we're going to start with that trading action for today. Our top takeaway today, which just moves in the 10-year Treasury yield, still remaining noteworthy and perhaps a headwind for stocks when we see the 10-year Treasury yield come up. So I want to take a look closer at some of the charts here, specifically with the S&P 500. You look at the S&P today, when we really started heading lower was right around 1 p.m., right? That's where we took that leg lower. Well, if we look at the bond market, Josh, and we look at what happened at that time, let's look at the 10-year. That's right when the 10-year started peaking up, right? And this is a trend we've been talking about for a while now. When I zoom out here and we look at the 10-year over the last 2 months, if I can get that to work, it's not gonna work for me. But over the last 2 months, you can see when the 10-year goes up, realistically, what's been happening is stocks have been down, right? Here's what I was looking for. So this is when the 10-year went up a lot, right? We were talking about it pretty much daily on the show. What happened in April? We had a 5% pullback in stocks, right? In the S&P 500. So realistically, just kind of the key trend to watch here has simply been when yields go up, it's a headwind for stocks. And on a day like today where it felt like Nvidia's up, positive vibes in the market, maybe a little bit of an AI rally, why didn't you see more out of the S&P 500? Sometimes your answer is right here and some of those bond offerings that happened at 1 p.m.
And Josh, also, like, listen, basically earnings effectively in the rearview mirror, so now you get back to macro and you start focusing more on the benchmark 10-year. When you're kind of combing through the notes, what are some of the levels, analysts, strategists, technicians, what are they looking at?
I think as we get between 4.5% and 5% on the 10-year, it seems to just be anything higher is not great. There aren't a ton of technical levels I've seen highlighted recently. Like at one point we were looking 4.35 to 4.5.
Right, yep.
We're now past 4.5. So it's sort of where are we going to float in between there? But I think what you pointed out there is key. Just moving forward, especially this week when we have PCE at the end of the week, any moves that we're seeing in the bond market with earnings sort of in the rearview mirror, I think are going to be probably a big driver for the market.
All right, what's up next on the Schaefer target?
Up next, let's get back to earnings though, right? Because earnings are exciting to talk about, right? And another bullish call for the S&P 500, this one coming from UBS.
Jonathan Golub.
Jonathan Golub.
He's just so much TV, Jonathan. I want to get him back here.
We got to get him back.
He's good television.
We got to get him back to talk about charts like this.
Yep.
Because he's talking a lot about earnings, and really what stands out here, so this is consensus expectations for earnings growth, are these three numbers at the end. So we're looking for 17.6% earnings growth year over year in the fourth quarter. That number's been moving up. So is this number, and so is this number. So this number, 11.4% on the year, that's been steadily moving up over the last 2 months. So has this number for 2025 at 14.2%. And what Golub points out, normally those move down. So go back here and you take a look at 11.4%. Normally this number would be coming down and it would look more like this blue line here. But what's happening right now is analysts feel better about the earnings outlook. And if we're feeling better about the earnings outlook, that is a good thing for stocks. So to see it this resilient up here is something that multiple strategists have been highlighting. Say, okay, the earnings outlook is better than we thought. That's net just a positive for stocks and a positive for the rally.
So companies doing better than maybe they initially thought. If you looked under the hood, not necessarily what Golub's seen, but just in general, Josh, where do you see sort of that positive earnings revision?
Yeah, so going back to the start of April, it's been utilities and energy. Utilities and energy have had the best earnings revisions of any of the sectors in the S&P 500. Of course, if I were to pull up a chart of sectors over the last 2 months, utilities and energy have been rallying pretty good here. So you've certainly seen that playing out in the market thus far.
Give me the third one.
We got one more takeaway.
You have to end on that.
We cannot talk about Nvidia, right? All-time high today. Closed over 1,100 for the first time. And I think what stuck out to me, I saw this chart from Goldman Sachs, Josh, and what we're looking at here is data center wallet share, so sort of where the spending's going in data center. You can see Nvidia is in purple.
Look at that.
I don't need to say much here.
Great chart.
You can just see the purple slowly take over.
Yeah.
And what this means to me is when someone like Elon Musk says that they're building AI and they're going to need some way to power it, it's these guys in purple, right? It's all Nvidia, and Nvidia benefits from that. Stock was up, I think, about 5% today. So it's been interesting to just see how they're sort of dominating this market right now.
You know, Elon Musk comes out, Josh, and he says, my startup XAI, we're going to be a player. We're going to take on OpenAI. We're going to take on Meta. I'm going to raise $6 billion. Investors just think, well, then you're going to need Jensen Huang.
Jensen Huang talking
how
up,
much that $6 billion
talking
just
up
flowing
Elon
right
Musk and AI to Yahoo Finance last week,
here,
right?
With Julie and Dan Howley.
It all starts to add together a little bit, doesn't
Joshua, thank you. Appreciate it. Memorial Day weekend's box office was a flop. But is our moviegoers going to blame, or is it Hollywood's fault? We'll discuss on the other side. More Asking for a Trend coming right up. U.S. movie theaters had anything but a relaxing holiday weekend, with the box office seeing its worst Memorial Day weekend performance since 1995 and a 37% drop just from 2023. Joining us now to discuss the outlook for theaters is Chad Bynum, Macquarie Senior Analyst, Gaming, Lodging, and Leisure. Chad, it is good to see you. So it sounds like this summer box office, Chad, not off to a great start here. What explains it?
No, thanks for having me, Josh. As you just illustrated, it was a tough weekend. Look, generally, this is kind of the start of the summer. You see about 20 million people who go out over the 3 or 4 day period. In this year, we saw, somewhere between 10 and 12 million. So then the questions are, is it the consumer? Is it the overall experience? Or was it a lack of content, given the strikes that we had and kind of the delay of the backlog? There were 2 big wide releases, and the scores that we've seen, particularly on Furioso, were pretty strong in terms of, just the reception of the movie. So we are scratching our heads. We're searching for another Barbenheimer, but we're going to have to wait until later this year to kind of kickstart the industry.
You mentioned, Chad, last summer, right, Barbie, Oppenheimer, it was just this cultural phenomenon. Is there anything like that, Chad, coming down the pipeline?
Not to that degree. I think the slate does look strong in the back half of the year, and in particular in 25. Actually, over the past week, we saw more movies that were announced to be delivered in 25. So there's nothing that's kind of a huge following. As a reminder, sometimes it's the original content that kind of come out of left field and do $200, $300, $400, $500 million domestically. Wicked, there's a few surprises that we like in the fourth quarter. I could go through the list, but a lot of sequels, and then you have a couple original films, particularly in Q4. I'm just curious, I know you don't cover the names, but even just generally speaking, Chad, does this kind of performance, does it put that much more pressure on Disney's and Universal's in terms of what they have coming? Absolutely. The past couple of years, we've been excited to see more diversification from the studios, right? Some of the independent films, the Apples, the Amazons, the A24s, elevating their presence and contributing more. Because I think pre-COVID, Disney Studio accounted for almost 40% of admission revenues in North America. We want some more diversification here. So yes, absolutely. We think there's a lot of pressure on Disney's production, making sure that lands well with that younger audience. And we just haven't seen that over the last couple of years. In terms of number of films, pre-pandemic, we were around 130 across all the studios. From a widely released standpoint, we're inching up to 100. So in 25, hopefully we get closer to that 130. But I do think some of the, Goliaths in the space need to put out some high quality content. I'm interested, Chad, when you just think about kind of overall box office as an industry, how much smaller is it, Chad, now than pre-pandemic? And how do you see it kind of evolving from here? Yeah, we're right around 25% lower than pre-pandemic, and that's on admission revenues. And remember, ticket prices have continued to go higher with inflation over the past couple of years. So admissions are actually down more than 30%. Admission revenues pre-pandemic were in that $11 billion range. This year, we're going to be a little shy of $9 billion. And then in 2025, we're expecting something closer to $10 billion. The industry has shrunk. Companies like AMC have reduced their screen size by about 10%. So they've taken out a lot of the lower performing screens across the country. The big winner, relative winner, is IMAX. This weekend, for instance, they did 20% of Furioso's admission revenues, and they have about 2% of the screens in the United States. So clearly the consumers who are going to the movies are choosing the premium experience. So you would say, Chad, just for viewers, for investors who are listening right now, IMAX is a buy here? We like IMAX. IMAX, we have a $24 stock price. They generate about a third of their profits in North America, a third in China, and then a third in rest of the world. So they're diversified. The second reason is they have a backlog. Similar to what we see with the hotel companies, IMAX should grow their units anywhere between 8 and 10% per year for the next 3 years. And those are orders that just need to be fulfilled. And they're also a ticket taker. They don't run the exhibition arena. They just take a fee on the number of admission revenues that come in the door. So it should be a higher multiple company. In the early teens, this is a company that was trading 15 to 20 times EBITDA. Right now we have it trading at 7.5 times EBITDA. So I don't think it'll get back to that franchise multiple like a hotel stock or some of the fast casual chains. But I think it's a value stock with good growth. It's just been masked by everything that we're talking about today with a general lower backdrop.
Chad, you were the perfect guy to talk about this story today. Thanks so much for coming on the show. Appreciate it.
Thanks, Josh.
Coming up, Wall Street's favored recession indicator is not indicating like it used to, more asking for a trend. It's on the other side. Wall Street may have a problem. One of its favorite recession indicators has been flashing warning signals for more than a year, but we haven't seen one yet. So is the indicator broken, or are we in store for a slowdown? Julie Hyman joins us now for a closer look. Julie.
Yeah, this is something that the Wall Street Journal highlighted today, that it has been something like 400 trading sessions that the yield curve has been inverted. That's the difference in this case here between the 10-year yield and the 2-year yield. And every time we've seen it invert, in other words, the 10-year go below the 2-year, we have seen a recession. This goes back all the way to the 80s. We have inversion here that is going below zero here. Then there was a recession. Going inverted here, recession. Inversion here, recession. Inversion here, recession. It even had inverted before the pandemic induced recession. So now we have the inversion that is going on 23, 24 months, which is exceptionally long in the tooth to last before we see a recession. Now, to back up for just a second here, what even is a yield curve here? We're talking about the difference between long-term and short-term bonds, the yield on long-term and short-term bonds, and it looks at the relationship between the rates of interest. We tend to see this inversion when the market anticipates a rate cut coming from the Federal Reserve, and that's why we see those long-term yields slip below the short-term yields. So very long here, and sort of adds up with all the other confounding economic data that we've gotten recently, Josh.
So do we have a why here, Julie? What explains this conundrum?
So it effectively seems to be that people got it wrong, what the economy was going to do and what the Federal Reserve was going to do. Recall in 2023, it was very difficult to find an economist or a market strategist that predicted that the economy would continue to expand and that stocks would continue to expand. So there was a lot of pessimism that got sort of baked into this inversion. As we know, this is sort of the Federal Reserve rate cut that has not arrived. And so the longer that goes on and this inversion goes on, the longer it just says that people were wrong about their predictions effectively. Even the guy who sort of popularized this thing is quoted in the journal, Campbell Harvey, who's now a finance professor at Duke, said he can't rely on a single measure to be sort of this magic predictor of recessions, even though its track record has been very good in the past. And combine that, Josh, as I said, with, we got a lot of other confusing indicators out there right now. You had a consumer confidence reading today that came in with a rebound for the month of May, but that's not necessarily reflected in other figures. So, in other words, it's really hard to be an economist right now and try to predict, and to be a market participant trying to figure out if and when a recession is coming.
It is indeed. Julie Hyman, thank you. Appreciate it. Time now for what to watch Wednesday, May 29th. Before the opening bell, investors can expect to hear from several retailers. Abercrombie & Fitch, American Eagle, Dick's Sporting Goods, and Chewy all set to deliver first quarter results and give more insight, of course, into consumer spending. This coming as consumer confidence saw a move higher in May after 3 straight declines. Then after the market closed, we're going to look into tech with names such as Salesforce, C3AI, and HP Inc. also reporting their latest financial results. Investors to eye spending in cloud and business software offerings from Salesforce customers, while keeping watch on commentary from HP on a recovering that PC market. And turning to the Fed, New York Fed President John Williams and Atlanta Fed President Raphael Bostic slated to deliver remarks on Wednesday. Meanwhile, the central bank is set to release the Federal Reserve's Beige Book with the latest on current economic conditions. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.